Why quantitative easing exists, a reverse-engineered model of the modern banking system. Part 1. Introduction, framing the question. Quantitative easing, commonly referred to as QE, is one of the most widely discussed yet least clearly understood policy tools in modern finance. In public discourse, it is often described in vague or moralized terms: money printing, stimulus, asset inflation, or central bank manipulation. These descriptions focus on outcomes or optics, but rarely on mechanics. This exposition takes a different approach. Rather than starting with official explanations or institutional narratives, it attempts to reverse engineer the modern banking system from observable behavior. This includes how markets seize under stress, how collateral is treated, how liquidity freezes propagate, and how central banks consistently respond when failure threatens systemic stability. The core question is simple. If we observe the same interventions repeatedly across crises, what structural role must those interventions be serving? From this perspective, QE appears less like an economic stimulus tool and more like a structural necessity. It functions as a mechanism designed to stabilize the value of systemically important collateral in a financial system built on reuse, leverage, and rehypothecation. This essay does not claim insider knowledge. It presents a model, not a revelation. Like all models, it is provisional. It is useful insofar as it explains observed outcomes, and incomplete insofar as it omits hidden variables. Its strength lies in coherence, falsifiability, and alignment with real-world events, such as the global financial crisis, the COVID liquidity shock, and the collapse of Silicon Valley Bank. The goal is not to indict or defend the system, but to understand what it is optimized to do, and why QE keeps reappearing whenever the system is stressed. Section 2. The modern banking system as a collateral engine. At its core, the modern banking system appears to function less as a simple intermediary between savers and borrowers, and more as a collateral transformation and reuse engine. Fractional reserve banking is often explained as a way to create money, but operationally it is better understood as a system designed for capital efficiency. A single high-quality asset can be used to support multiple financial positions across multiple balance sheets simultaneously. This is achieved through lending, borrowing, and critically, rehypothecation, where pledged collateral is reused again and again within the system. In this framework, yield is not generated solely by productive investment, but by folding collateral through layers of financial activity. An asset that earns a modest yield on its own can become the foundation for additional returns when used as collateral for borrowing, market making, or liquidity provision elsewhere. This is not unique to traditional finance. It mirrors leverage and yield stacking observed in modern crypto markets. The difference is scale, opacity, and institutional backing. The implication is important. If the same underlying collateral supports many positions, then the system's stability depends less on credit quality and more on collateral valuation. A decline in collateral value does not remain isolated. It propagates. This sets the stage for understanding why liquidity, collateral pricing, and confidence are inseparable, and why certain assets become systemically sacred. Section 3. The role of risk-free assets. Within this collateral-centric system, not all assets are equal. A small subset is treated as pristine collateral. These are assets assumed to be liquid, reliable, and universally acceptable. Chief among these are United States Treasuries and, in certain contexts, government-backed mortgage securities. These instruments are labeled risk-free, but this designation refers primarily to credit risk, not price risk. Every bond has two defining attributes, a yield and a price. When interest rates rise, bond prices fall. This price volatility becomes critical when bonds are used not merely as long-term investments, but as active collateral supporting leverage. When a bank or institution holds such assets to maturity, price fluctuations are largely irrelevant. But when those assets are pledged, borrowed against, or marked to market, as they are throughout the modern financial system, price declines matter immediately. A sufficiently large drop in value can trigger margin calls, forced selling, or loss of confidence. This is the hidden fragility of risk-free collateral. Its systemic importance makes it intolerant to large price declines. Once such assets underpin a wide web of financial positions, allowing their market value to fall too far threatens the solvency of institutions that appear sound on paper. From this perspective, stability is not about avoiding default, it is about preventing collateral impairment. Section 4. Repo and reverse repo markets, the system's cashier. The repo, meaning repurchase agreement, and reverse repo markets function as the operational heart of this system. They are best understood not as abstract money markets, but as over-the-counter exchange counters where cash and collateral are continuously swapped. In a repo transaction, an institution exchanges collateral, typically Treasuries, for short-term cash, agreeing to reverse the transaction later. In a reverse repo, cash is exchanged for collateral. Together, these facilities allow participants to move fluidly between liquidity and collateral depending on their needs. Crucially, these markets operate on trust in collateral quality. When confidence is high, transactions flow freely. When confidence erodes, because collateral is questioned, counterparties fail or volatility spikes, private lending slows or stops altogether. At that point, the system reveals a structural truth. If private actors refuse to accept collateral, the central bank must. The Federal Reserve's presence in repo markets is not optional. It is the backstop that guarantees convertibility between cash and systemically important collateral, ensuring that participants can always exit or enter positions without triggering a freeze. Without this guarantee, liquidity becomes conditional. Conditional liquidity is indistinguishable from no liquidity at all during stress. Section 5. The overnight rate as an incentive mechanism. The overnight rate, often discussed as the Federal Reserve's primary policy lever, plays a more mechanical role in this system than is commonly acknowledged. It functions as an incentive structure for participants operating within these collateral exchange mechanisms. By setting the cost of short-term borrowing and lending, the Federal Reserve influences how attractive it is for banks and dealers to intermediate between cash and collateral. The spread earned through these activities compensates institutions for providing liquidity, absorbing risk, and keeping markets functional. In this sense, the overnight rate is less about macroeconomic fine-tuning and more about coordinating participation. It ensures that enough institutions are willing to operate the system's plumbing so that cash and collateral continue to circulate. Rate control, then, is not merely a signal. It is a coordination tool that keeps the collateral engine running smoothly. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 6. Liquidity crises and the necessity of the Federal Reserve backstop. When viewed through the lens of collateral reuse, liquidity crises take on a very specific meaning. They are not primarily about a lack of assets, nor even a lack of solvency in the traditional sense. They are about a breakdown in confidence around collateral acceptability and valuation. Because the same collateral is pledged in multiple places, a failure at one node cannot be cleanly isolated. If a large participant fails, counterparties are forced to reassess not just that institution's creditworthiness, but the quality and market value of the collateral underpinning their own positions. This reassessment propagates rapidly. At that point, private actors behave rationally. They stop lending, demand higher haircuts, or refuse certain collateral outright. Liquidity dries up, not because cash no longer exists, but because no one is willing to exchange it for collateral at prevailing prices. This is the moment when the Federal Reserve's role becomes unavoidable. If liquidity shortages were allowed to persist, the system would enter a self-reinforcing unwind. Falling collateral prices trigger margin calls, forced selling pushes prices lower, and confidence collapses further. The Federal Reserve's backstop function exists to prevent this spiral. In effect, once collateral reuse reaches a certain scale, a lender and buyer of last resort is structurally required. Without it, the system cannot tolerate stress. Section 7. Quantitative Easing Reframed. Within this framework, quantitative easing appears in a new light. Rather than functioning primarily as stimulus, QE operates as collateral price support. By purchasing large quantities of Treasuries and mortgage-backed securities, the Federal Reserve creates a reliable, price-insensitive buyer. This places a floor under assets that are systemically reused as collateral. The objective is not to reward investors or inflate markets for their own sake. It is to prevent collateral values from falling far enough to trigger widespread margin calls and balance sheet impairment. In a system where these assets underpin multiple layers of leverage, price stability becomes synonymous with systemic stability. QE is therefore best understood as a defensive operation. It is activated when market pricing threatens the integrity of the collateral base itself. The Federal Reserve steps in, not because it prefers to, but because allowing risk-free collateral to collapse in price would force an uncontrolled deleveraging across the system. From this perspective, QE is not an anomaly. It is the logical extension of a system built on rehypothecation. Section 8, Case Studies. Stress reveals structure. Historical crises help validate this model by revealing how the system behaves under pressure. Lehman Brothers collapsed not simply due to poor assets, but because its primary counterparties, most notably JP Morgan, refused to continue lending against the collateral Lehman was pledging. Once that confidence broke, liquidity vanished instantly. The quality of the collateral became irrelevant. What mattered was that it was no longer acceptable. Silicon Valley Bank illustrates a different but related mechanism. SVB held large quantities of long-duration risk-free securities. Rising interest rates crushed the market value of those assets. When depositors demanded cash, the bank faced a choice: sell at a loss or hold to maturity. Either path revealed insolvency once assets were marked to market. The collapse was not caused by credit defaults, but by duration risk interacting with collateral valuation. In both cases, stress exposed the same underlying reality. When collateral values fall far enough, institutions that appear solvent can fail rapidly, unless a backstop intervenes. Section 9. Regulation and constraints. Regulatory frameworks such as Basel III attempt to manage these dynamics by defining capital requirements, liquidity ratios, and collateral classifications. These rules determine how much flexibility banks have and what assets qualify as high quality. Notably, Basel III elevates certain assets, such as sovereign bonds and increasingly gold, to Tier 1 status. This designation is not arbitrary. It reflects the system's need for universally accepted, low-volatility collateral that can survive stress. Any asset that competes with United States Treasuries in this role, whether gold, other sovereign debt, or potentially tokenized instruments, affects the system's equilibrium. The tighter the requirements, the more constrained leverage becomes. The looser they are, the more fragile the system grows. Regulation, then, acts as a throttle, not a cure. It shapes the degree of collateral reuse, but does not eliminate the underlying incentives. Section 10. Blockchain as a diagnostic layer. Blockchain technology introduces a powerful new variable: transparency. If collateral were tokenized and tracked on-chain, it would be possible to observe how many times a given asset is pledged, where it is pledged, and how interconnected positions truly are. Contagion pathways would become visible rather than inferred after the fact. However, transparency does not alter incentives. A tokenized bond can still be rehypothecated. Fractional reserve behavior can still exist on-chain. What blockchain changes is not the behavior itself, but our ability to measure its extent and speed. In this sense, blockchain functions as a diagnostic layer. It can reveal leverage. It cannot prevent it. Structural reform would require changes to rules, incentives, or the acceptability of rehypothecation, not merely better accounting. Section 11. Limits of the model and open questions. This framework explains several persistent features of modern finance. These include recurring liquidity crises, the inevitability of quantitative easing, and the centrality of collateral valuation. It aligns with observed policy responses and historical failures. Yet it remains incomplete. Internal balance sheet mechanics, derivative exposures, cross-border liquidity flows, and political constraints all introduce complexity not fully captured here. Confirmation from insiders or contradictions from future crises may require revision. That limitation is not a weakness. It is the defining characteristic of any honest model. Conclusion: what the model implies. If this reverse-engineered model is directionally correct, then several implications follow. Quantitative easing is not a temporary emergency tool. It is a structural feature of a leveraged, collateral-reuse system. The Federal Reserve is not merely a policy authority, but a necessary stabilizer of collateral value. Transparency, whether through regulation or blockchain, can expose fragility but cannot remove it without deeper reform. Ultimately, the system behaves exactly as it is designed to behave. Understanding that design, rather than arguing over narratives, offers the clearest path to insight. Quantitative easing exists not because central banks want it to, but because the system cannot function without it.